Started the day quiet enough, just testing our support levels on the S&P before we had a little rally heading into what was going to be a very exciting day. And all we're doing at this point is waiting for that Fed announcement. As the day progresses, we can start seeing testing that bottom level as they start trying to shake people out. And then the announcement comes out that we are 25 basis points and he is hiking 25 basis points. So what caused this stock market crash that has everybody panicked? Is this a buying opportunity or do we need to get out of the way? What the 2-year Treasury is telling us and which way interest rates are currently leaning. This one graph is giving us a signal. It's only happened 4 times in 10 years and it's telling us a lot about the conditions of financial banks. Rate hike days are always rather exciting, as you can see the little peak right here and on the news, and everyone was pretty happy that he came out. It was only a 25 basis point hike. And then you just have that level right here that you always use. It's that first bar that tells you really clearly what you should be focused on for the rest of the movement, at least for the beginning before he speaks at 2:30. Once Powell speaks at 2:30, you find that low point and you mark that. That becomes a demarcation line. You can see how we respected that here and how that held the first time, presenting a great opportunity to buy for a swing trade. Now, the question is, what do we have going on right now? Well, we came back up and tested this level. Everyone's blaming Yellen for saying we are not going to raise the FDIC deposit limit. Well, that's not a shock that they're going to come out and say that, because what they're suggesting by doing that was that you could just seriously increase the risk of the banks if you were going to do that. Nobody wants to see that happen. So I don't know if that's the reason for the sell-off. We have a lot of people saying that's the reason. I would go on the expertise of what is the option market telling us. Now, if we look at the option market and the amount of options that expired today, this was a classic setup and had absolutely nothing to do with Yellen, in my opinion. They're just looking for causation. So let me just walk you through it. You pop over this level, you convince everybody that you're going to go up, and then what do? You get liquidity. When you get liquidity up here, you get all the people buying those calls on the S&P, and then what do the option market makers do in the algos? They just absolutely crush you. Very similar to here, you broke that bar, but you never closed below it. What are they doing? They're getting liquidity on you, and then they're ripping it higher. Okay, so you're seeing these games played over and over again. This is the bottom line. Whether this is Yellen, whether this is the options that were expiring today, which is where my head is leaning, it doesn't matter. All it matters is that it tried to break out and it was unable to do that and then pulled back and bounced around. Now, why would this happen? Why would we sell down, panic over something like this? It doesn't make any sense. Now, if we take a moment and look at the financial sector, we can see a very similar pattern here. And you can see the drop because obviously we're going to move like the financial sector is going to move exactly like the S&P. The move doesn't make any sense because they raised 25 basis points. He came out and spoke. And what did he say when he spoke? He said that he was going to really look at the situation. How did he open up his entire speech? He started talking about the banks. The banks is what he started the speech with. That is their focal point. Now, could this have been Yellen? Maybe, but the bottom line is, what does the increase in FDIC mean for the banks? That they get to lever more? What if they left the FDIC the same exact way? Why would financials simply sell down on that? If you connect those dots, then you're welcome to comment on it. It doesn't make a lot of sense. Now, for those that are saying that we're not going to pivot and he's not signaling rate cuts, he was very clear in his language today. The article in front of us is by Zero Hedge, and they do a really good job explaining exactly what I was just pointing out. As they quote this gentleman right here, the choice to start the presser with a discussion of the banking system as a clear policy message. The mini banking crisis is the most important thing the Fed is thinking right now. It's exactly what I thought. That's their focal point, not inflation. Their problem is the faith and whether or not they have the people behind them. And they did until Yellen spoke, but is that the reason that we dropped? Well, we're going to get into that, and we're also going to look at what they're doing in the financial space, what corporate insiders are actually doing. Now, Powell went out of his way to state that deposit flows in the banking system have stabilized, noting their strong actions, but failed to comment on the massive rotation. And that is a problem. Now, the blue line, very simply, is big banks and the red line is regionals. And we'll cover that a little bit later. But I just wanted to focus on a couple things here that They really nailed in this article, and it's much easier from using this one document to explain it. They considered a pause, but hike was supported by a strong consensus. As a matter of fact, it was unanimous. They dismissed rate cuts are not in our best base case, meaning that they're not thinking about it right now. Some members recognize the impact of the financial crisis on credit tightening, which could do the job of some rate hikes. If they don't lend money, which it looks like regional banks are going to stop lending the same way that they have been lending, this could replace rate hikes. Now, this is being attributed to when we just rolled and we looked at that 3 o'clock level. You see this quote right here at 308. Why is this important? Is this why we actually came in? Because they're not going to increase the deposits from 250 to 2 million? Is that why we came in, or did we come in because they were looking for a reason? I'm going to suggest that they were looking for a reason. We saw very orderly buying and selling throughout the day until that last hour mark, which we know the panic starts to set in for the option traders. And there was a lot of options out there today. Now let's talk about what are the probabilities for the Fed meetings. And what are we looking at right now? Well, look at the target rates and look how they changed in regards to what we're looking at. Now, if he's coming out and saying that their rate is roughly 5.1%, why do 47.6% look for that 450, 475 level? So in other words, the only reason that you would suggest that is that the probabilities are leaning towards rate cuts. This is objective data. This is not subjective. It's not open to interpretation. This is the probabilities that are on our target rates. It's really that simple. Now, in front of us is the implied overnight rate and number of hikes and cuts. Implied policy rate percentage. Orange, number of hikes, cuts priced in. Implied policy rate percentage is in blue. See how it goes up to where they're saying the terminal rate is going to be, right around that 5%. By the way, Bank of America cut their rate today by 25 basis points. You will see other firms do that by tomorrow. See how you're starting to drop here? The only way that this actually will work out so that by 24 you would be down to possibly 2.4 is look at the number of hikes minus the number of cuts. So they're saying by the end of the year, they're at 3 cuts by January 24. This is what's priced into the market right now. This is irrefutable. This is objective. So whether or not you think they're going to cut or they're not going to cut, it's completely irrelevant. Okay, this is the implied policy rate on what you're dealing with right now. Investment banks are cutting the hikes and stating that the probabilities are leaning towards cuts. And you're seeing this with the way that they're betting. In front of us is the 2-year Treasury. And what we can see is very clear right here. We can see the peak right here at 415. And look at what time that was right before the market had the news. 25 basis points. What do? From there, we just drop down till we hit lows. And those lows are right around that 3 o'clock level. But there's something very interesting about this, and I think it's worth noting. There is a huge divergence going on here. So the bond market always knows. Now, what is the bond market doing? Came all the way down here to 390 from here. These moves in the 2-year are absolutely insane. And this shows massive buying or short covering in treasuries. You're not doing that if they're doing rate hikes. Don't look at what they say, look at what they do. They are buying the 2-year as much as they possibly can. 3 o'clock comes out, and let's just say that Yellen made that speech and that scared everybody because now rates are going to go higher, blah, blah, blah. Okay, what did the bond market do? Bond market couldn't get anywhere. Bond market couldn't even get past 230. So all the bond market did was keep having buying coming in and buying. So that's telling you emphatically that the bond market, they are buying now. Now let's look at this divergence that happened at 2 o'clock. We should all be able to see this, but we're just going to mark it so that we can really dive into this. I think it's important that we just look into this. There's our 2 o'clock level. This is the news at 2 o'clock. 2:30, the line is Powell speaking. From his speech on, you had nothing but buying of bonds and rallying of the equity market. 3 o'clock is Yellen's speech. Market comes down, tries to rally, and cannot rally. Now, you'll see an enormous difference here in how this reacted versus how we reacted in here. We came down, tested, held. So in other words, they're still buying bonds, but they're selling equities. Well, something doesn't add up. So is it Yellen, or is it the fact that you had huge out of the money options expiring today? Either way, it doesn't matter. The market went down. And in my opinion, there's going to be some ability to profit from that. We're going to get into that now, but it's really important to get this before I go on to the next. Now, in front of you is corporate insider buys. Why is this important? Corporate insider buys of the financial sector. The green line means that the financial companies are excited about their stock, and the red line means that they are very pessimistic, meaning they are not currently buying their stock. You can see that back here in November, telegraphing pretty clean what's in here. And you can see these massive peaks over a 10-year period. And obviously these peaks are when they were most bullish, right? And you can see those lows based upon where they were most bullish. But there's a lot more to this chart. If we take a look at these other peaks that are right here, and we see this line of 40 right across here, and we just kind of take a look at what happens at that 40 line. We're just going to draw that line right here so you can see where we're at. You can already see that the bottom of these two levels and what that signified. And no, we're nowhere near that. Let's be very clear about that. But look what happened in 2014. Look at how we bottomed right there and look at what transpired. So in other words, when we got over 40, what did they do? We bottomed in financials and wound up pushing higher for about a year. Of course, you come back down and then you have more buying. Now, if you just keep looking at this pattern that I'm trying to point out, here you are at the 40 level. Well, what happened here at that 40 level? And then we can kind of just take a look and go, well, we kind of went a little bit higher there into 18, 19, didn't we? More in 18. We know that 19 was a little bit of a mess. And you can see that right here. Once again, that's 40. So here are 4 indications and 4 spots that called the low in the financial market. Well, here we are popping over what level? 40. And where are we right now in the financials? We are right here. To be clear, XLF is sitting right here right now. Now, I just want to point something out. We can all see that this is that September, October area right in here in 2022. And we can all see that this is where we currently are. So here we have low of the market, and here we are here on the financials. Now, why is this important? They are more bullish here on buying financials. Insiders are more bullish here in buying than they were bullish here. In other words, the XLF did not even take out the October low, and insiders are more bullish here. Now, insider buying is no guarantee of anything, but it's certainly important to note, and it's certainly not telling you that you're going to miraculously go up tomorrow. But ignore that at your own peril when you start realizing all this buying in here is one of the highest buying areas by corporate insiders in the past decade. A matter of fact, there's only been 2 times higher than that level as we showed you previously. So before we get into names and how we're going to benefit from what transpired today, does this look good? No, it does not look good. Could this go lower? Yes, of course we could go lower. And the bottom line is we could sit here and pontificate and nobody knows. You have a DTL right here, downward trend line. You broke that downward trend line and then were unable to rally above it. Could we sell down for 2 days and then bounce? Yes. Do I think we're taking out new lows because of this? No, I don't see that. And I don't see systemic problems to the market. And I couldn't be wrong. I mean, please comment. I don't see systemic problems. I see that they're not getting their statements aligned correctly. I saw a little bit of that today. I mean, it's kind of hard not to say that. But do I think we're going to break 3,800? I don't know. I don't have a clue. And quite frankly, anyone that's telling you they know, they don't know. So we stopped right at that 200-day, which is kind of interesting, but that doesn't mean that we're going to hold. So we're going to have to watch this area. But what does this mean going forward? Well, it just means that we know where the DTL is. We know this is an area we have to watch. Now, does it mean that the move is over? Now, this is a graph I put out in the newsletter. The newsletter is free, link in description. Make sure you get it. The one that went out today showed you exactly 2 ideas that we did in the Alpha Chasers community and how we did them. Step by step, we walk through it. Now, what this graph is showing is unrealized losses versus deposits above 250,000. Here's deposits over here, y-axis, x-axis. SIVB, SBNY were the outliners. FRC is the next domino that might fall. Now, it has been since last Friday, and I'm going to just shrink that down for now. It has been since last Friday that we have been told that they are doing a capital raise. It is abundantly clear that nobody has any interest in this company. Now, tonight you had another downgrade of their debt. And now you're going to see another downgrade because they already said, by the way, we're probably going to do another level downgrade, which they probably didn't do solely so that the company could try and get its act together. Is this company going to be around or not? I don't know. And is this weighing on the market? Yes, it is going to weigh on the market, but we're going to have to see how it plays out because to me, we're not seeing the panic. High yield bonds finished up on the day, HYG. A very simple way to look at this. From the open, you did not sell down. So if we were panicked or we saw some structural issues here, why is this continuing the way that it is? It wouldn't. It would sell back down. People would not want to own these bonds. They'd be afraid of systemic risk. Now, I do read all your comments. And that is why I'm showing this graph again, because you asked me to follow up. So if you have more comments on how we can make these videos better, just let me know. This is from Sentiment Trader. This is BBB, AAA, low end of the investment grade to the top end of the investment grade. And it takes the bond yield spread between the two. So what are we seeing here? We're seeing the S&P turn up. And what are we seeing happening with the bond yields? They are getting tighter. They are not getting wider. They do not get tighter in environments that are leading to systemic risk. This does not work that way, right? They would get wider and wider because you'd be taking more risk. What they're saying is it doesn't really matter right now, and they're getting tighter and tighter. To put this in perspective, this is where you were in October, and this is where you are now going through a banking crisis, and we can't even get the spread to rise to a level that we were in October. If you look at that, and the reason I'm showing you this is you can actually correlate this bond yield spread to the inverse of the XLF, which lines up perfectly with insider buying. So who do you think understands their bonds better or the bond market better? The bankers that are buying their stock? I'm going to go with them. For now, the top name that I'm looking at is Goldman. It makes the most sense. They're not going to go out there and buy a regional, so I'm not going to have to worry about that kind of risk. What I'd like to see is I'd like to see if we can get back down to this 307, 305 range. Maybe that could present an opportunity to get involved in the name. But if I had to pick one that makes the most sense to me right now, it would be Goldman because of the sheer size of them. They're not going to have problems unless we have major problems across the board. There are some other names that are hanging in there, and I would not rule out. You know, Schwab's one that we've traded several times, and you're still setting up in here. We're still up over $2. We did trim at 60 after hitting there several different times now. You are forming a bear flag here. I do see that, right? Here's your flagpole, here's your flag. Some could actually argue that this is the pole, right? Because this is the pole previous to this, and this would be further away. So you could actually argue that this is the flagpole and you're actually going to have a bull flag. Now, it's a fun argument to have, but it's semantics. Whichever way this breaks is how it's going to go. But you're going to need to see the close. You're going to need to see it close below there. But overall, Schwab has come out and issued statements, and I'm very comfortable with the idea, and we've been doing well in it so far. Now, this was another one that we traded, and I still like the idea. PACW came out and showed their balance sheet today and said they have no reason to raise capital, that they have over $11 billion after they would cover their uncovered losses. Last week, they reported they only had $10 billion. So that reserve seemed to have gone up, and for some reason, the stock sold down on that news. We dropped 17%, but the preferred only dropped 12% because you're getting that dividend yield. So why we have fear, as I stated in that newsletter, and I'd make sure you get a copy of it, when you have fear, you have disassociation, you have mispricing of assets. That provides huge opportunity. There's nothing more than I like than when everybody's panicking or everybody's excited, right? Because the ship can only lean so far one way before reverting back to some kind of mean. Case in point is NVDA. Nobody liked the name. Now everybody has to own it because AI is going to dominate the world. And they played people like an absolute fiddle today if you take a look at this market. If we just look at this, and I would still have this name on your radar. Caveat, I bought it at the close. I bought calls at the close, and I've been buying it after hours since the 4 o'clock print. So I like the name, and I think that if you liked it up here at 276, and you're green today with the indexes being down close to 2%, and you're getting this kind of opportunity, but you think miraculously that everything's just going to come in, you're not really understanding what's going on. And you're not understanding the charts that I showed earlier yesterday of all the investments that are going into these charts, right? We went into this and we talked about all these buyers that are out there, all these institutions and how they're buying. Now, are they going to take profits? I'm sure they did today. and that creates volatility and opportunity. You can see from that 2 o'clock level how you held in here. And very simply, this was very easy read today. You can see your 200 right there, but I want to make that a 9 so that you can really drill into this and see this, because to me, this was just absolutely glaring, and it was just literally like picking fish off in a barrel. And all you're really looking for here is that 9. And I did that whole video. I'm going to link that video at the end, and I strongly suggest that you watch it, because this was the easiest stuff in the world. You buy at supports. Right down here, you will see a VWAP. When you get to that VWAP and you start battling that VWAP up here, and you're flipping and you're holding that support, it provides an opportunity, gets above the 9, gets above VWAP, and that was it. Rallies up. So I was able to put a little trade on there, rally it up, sell into when everybody got giddy. If you wanted to be on the other side of this trade, look at the 9, look how it broke, look how that called the top. And then you can see it from there. Look how it flipped once again. Wash, rinse, repeat. You could do this over and over again. I would watch that video. It's 10 minutes long. Now we've come a long way in a short period in time. And you can see that this is really the top end of that level. So you're really looking at that 272, 273. That was our target on the trade. Actually, it was the top of this bar. The exact reading was around that 273 level. That's what I was shooting for, and we got there today. So I did have some options. I did close some of those, but this provided a nice opportunity to get back into it. Now, is it going to hold? Is it going to rally tomorrow? I'm not sure, but I will tell you this. How many names actually closed above their previous close? Not many. Of course, you're going to see the panic. We saw the panic today, but that panic presents buying opportunity. Tesla battled with our level. It's down a little bit post, but look at where we're at. We didn't even make a lower low. So one of the top technology companies in the world with one of the highest PEs couldn't even make a lower low. And we're seeing this everywhere. Meta could not even make a lower low. Now we're still fighting the neckline on the stocks, and we got over it today, making a higher high only to pull back. But once again, we did not make a lower low. The issue that we're having is pretty much clear. We have a problem in the banking space, and we are seeing that issue, and we're seeing it spill out into other names. And it will affect us, sure. Of course it's going to affect the market. You're going to see names like Goldman. They're going to rally, they're going to drop. They're going to present an opportunity for us to get involved. But you're going to see other names out there that are also going to present an opportunity. So you have Ken Griffin that took a 6% stake in WAL. Now, he's not doing it to day trade it, but he's taking positions in these because he believes in these companies. PACW came out and confirmed their balance sheet. So I get it. If people are still going to be uncomfortable, then they're going to be uncomfortable. And maybe Yellen's comments did affect the financial markets today, and maybe they did affect the finance space. It doesn't really matter. What matters is what happens next and then how we're going to benefit from it. And the big issue that we have right now is this company. You can't even technically look at this chart and feel anything about it. I'm currently still short, and I only started a couple days ago. I actually reversed on it. I thought that they might get it together, and then it became really clear over the weekend, and it just wasn't going to happen. But now when you're seeing these downgrades of debt, this is just a matter of time before people just start pulling more money out of the bank and the panic. So if you found this helpful, please comment. Let me know what you liked about it, what you don't like about it. Let me know what you agree with, what you don't agree with. Anything like that helps me. Do yourselves a huge favor if you haven't gotten the newsletter. Just make sure you screenshot this. I have it on Twitter too, but just screenshot this so that you can look at all the banks and you can see exactly, I'll pull it up here in case that little video pops up, so that you can look at all the banks and you can make a decision for yourself at what kind of risk you want to take, if any at all. Everybody have a great night.